The S&P 500 just hit a brand new all-time record high today.
Right, closing right around 7,800.
Yeah, and the NASDAQ and Dow, they were right there with it, pulling massive percentage gains across the board.
And meanwhile, if you're watching the bond market, the 10-year Treasury yield is hovering right around 4.65%.
Exactly. So we are skipping the long intros today and just jumping right in.
Yeah, because we have a ton to cover.
We really do. If you glance at your retirement account today, the champagne corks are popping, right?
Oh, absolutely.
The narrative seems super straightforward. The market is basically celebrating the holy grail of economics. Inflation is supposedly cooling off, and this massive wave of corporate AI spending is driving growth.
It looks perfect on the surface.
Right. But underneath that massive rally, if you dig into the actual data we got today, the Federal Reserve is, well, they're quietly terrified.
It's a profound disconnect, honestly.
Yeah.
The equity markets are trading on this absolute best-case scenario. They're pricing in a flawless soft landing.
Like nothing could go wrong.
Exactly. But the central bankers, the ones actually steering the economy, they're looking out the windshield at, like, the next 5 years.
So what are they seeing?
They're seeing structural fires that have definitely not been put out yet.
And that tension right there, that is exactly what we're going to unpack today. So welcome to today's deep dive. We've got a massive stack of sources from today, August 13th, 2026.
A lot of conflicting signals to go through.
So many. We're looking at fresh macro data from the BLS, some really deep market analysis from AGF perspectives and Scotia Wealth Management, and a bunch of corporate earnings that range from the most advanced AI hardware on the planet to, and I'm not kidding, commercial washing machines.
Which sounds completely random, I know.
It really does.
But the connective tissue between a high-tech semiconductor plant and, a laundromat, it's actually telling the exact same story about how our economy is fracturing right now.
Okay, let's unpack this. Our mission today is to help you, the listener, make sense of this massive data dump. We're going to decode these conflicting inflation signals, look at what analysts are calling the great AI bifurcation, and figure out what all of this actually means for your portfolio.
Sounds like a plan.
Let's start with the big picture, the broad vital signs, because that S&P record high today was triggered by one very specific data release.
Right, the July Producer Price Index, or PPI.
Yeah. Now, before we even get into the actual numbers, can you just explain why the market cares so much about PPI? Because usually on the evening news, we only hear about CPI.
Right, CPI is the famous one. The easiest way to think about the difference is to picture inflation as a pipeline.
Okay, pipeline.
The Consumer Price Index, CPI, that's what you pay at the cash register.
At a grocery store.
Yeah, that's the very end of the pipeline. But the Producer Price Index, the PPI, that measures the wholesale cost of doing business.
So like the factories.
Exactly. It tracks what manufacturers, farmers, logistics companies, what they are paying for their raw materials and their energy, before they ever box up a product and ship it to a store.
So it's basically a crystal ball for consumer inflation.
That's a good way to put it.
Because if costs are going up for the factory, eventually they just pass those costs down the pipeline to us, the people buying the stuff.
Precisely. It is a leading indicator.
Yeah.
And that is exactly why the market reacted so violently to the upside today.
Because the numbers were good.
Very good. The headline PPI number for July came in completely flat.
Like 0%.
0.0% month over month.
Oh, wow.
Yeah, and Wall Street forecasters were expecting a 0.2% increase.
So hitting absolute zero is just a massive sigh of relief for stocks.
Huge. And on top of that, the year-over-year headline number fell down to 4.7%.
Okay, wait, let me stop you there.
Yeah.
Because looking at the sources, they also highlight something called the core PPI. And apparently, that rose by 0.2%. So why do we strip things out to make a core number? Does that mean the flat 0% number is fake?
No, it doesn't invalidate it at all. It just provides a different lens. So core PPI strips out food and energy costs.
Because they bounce around too much.
Exactly. Food and energy are wildly volatile. A drought in the Midwest or, some sudden geopolitical event can spike wheat or oil prices for a single month.
And that would distort the real trend.
Right. It distorts the underlying structural trend of the economy. So by looking at core PPI, which only rose a very modest 2.2%, the market sees that the basic cost of manufacturing goods and providing services is stable. It's not spiraling out of control.
But I do want to focus on that energy component for a second, because the sources dig into exactly why that headline number was flat, and it's almost entirely driven by a massive drop in energy costs.
Oh, yeah. It was the main driver.
The data shows that the cost of final demand goods actually fell by 0.7%. And the biggest reason for that was a 5.7% drop in wholesale gasoline prices.
That's a huge drop for 1 month.
Yeah, and a 3.1% drop in overall energy costs.
And, I mean, energy is the absolute lifeblood of the supply chain. Energy costs bleed into the price of literally everything else in a modern economy.
Okay, walk me through those mechanics. How does a 5% drop in wholesale gas actually translate to the rest of the economy?
Sure. Think about the journey of just a basic consumer good. Let's say a couch.
Okay, a couch.
The lumber for the frame that has to be harvested using diesel-powered heavy machinery.
Right.
Then it gets loaded onto a diesel train or a truck sent to a factory. The factory uses massive amounts of electricity, which is often generated by natural gas or coal, to run the saws and the assembly lines.
And then they have to ship the finished couch.
Exactly. It gets put on another truck to a distribution center, and then finally another truck to your local furniture store. At every single point in that chain, energy is being consumed.
So if wholesale gas and overall energy drop by those big margins,
The embedded cost of that couch drops significantly way before it ever hits the showroom floor.
that makes total sense. It relieves the pressure on the producer.
Yes, when a producer's operating costs drop, they don't feel that immediate panic to hike the final price tag just to protect their profit margins.
Right.
And that dynamic, applied across millions of products across the entire country, is what the market is celebrating today. The pipeline of inflation really appears to be cooling.
And adding to that celebration, we also got fresh labor market data today.
We did.
Initial jobless claims, which that's the people filing for unemployment for the very first time, right?
Correct.
So they ticked up slightly to 209,000. But continuing claims, the people who have been on unemployment for a while, they actually fell to 1.777 million.
Yeah.
And the overall insured unemployment rate is holding dead steady at 1.2%.
Which means the labor market is behaving almost perfectly. It's like the textbook definition of a soft landing.
It's not running red hot anymore.
Right. It's not like the immediate post-pandemic years where companies were just hoarding labor, aggressively bidding up wages just to keep the doors open.
But it's also not collapsing.
Exactly. We aren't seeing a recessionary wave of mass layoffs. It's finding an equilibrium.
And there's a specific data point from Edward Jones in our stack that really caught my eye regarding this equilibrium.
Oh, the productivity numbers.
Yeah. They noted that labor productivity increased to a 1.4% annualized rate in the second quarter. And they pointed out that since 2023, labor productivity has been growing at an average of about 2.5%.
Which is huge.
It is. It's literally double the average we saw throughout the entire 2010s. And along with that, unit labor costs only rose 1.3%, which was well below the 2.2% economists expected.
I would actually argue that productivity metric is the single most important number in this entire macro segment.
Wait, really? More important than the flat inflation number?
Absolutely, because productivity is the mechanical engine that actually allows for long-term economic growth without triggering inflation.
Okay, explain how that works, because productivity just sounds like a corporate buzzword to me.
Right, it sounds like middle management speak.
Yeah. How does an employee being more productive actually fight inflation on a macro scale?
Let's strip away the corporate jargon. Productivity simply means how much output a single worker produces in 1 hour of labor.
Okay.
Imagine a worker at a bakery. She traditionally bakes 10 loaves of bread an hour, and she gets paid $20 an hour.
So the labor cost per loaf is $2.
Exactly. Now, if she goes to her boss and demands a wage increase to $30 an hour, the boss has a problem. To maintain his profit margin, he has to raise the price of the bread.
Right, because the cost of the input, the labor went up, so the price of the output has to go up.
That is wage-driven inflation. But let's say the bakery invests in a new, highly efficient oven, or they implement a new software system that just streamlines the mixing process.
Okay.
Now, that same worker, in the same 1 hour, can bake 20 loaves of bread instead of 10.
Her productivity doubled.
Exactly. Because she is producing twice as much revenue for the business in the same amount of time, the boss can absolutely afford to pay her that $30 an hour, or even more.
Without ever needing to raise the price of the bread for the consumer.
That is the magic bullet. Higher productivity acts as a shock absorber.
So it allows companies to pay workers more money, which keeps the consumer economy healthy, but it prevents those higher wages from bleeding into the final price of the goods.
Yes. And seeing productivity growing at 2.5% since 2023, double the previous decade's average. That suggests that all these investments companies have been making in automation, software, and, remote work logistics, they're actually paying off.
It's keeping unit labor costs down.
Exactly, which takes immense pressure off the inflation pipeline.
Okay, so if I'm looking at this dashboard of data we just laid out, PPI is flat at 0, wholesale gas prices are down nearly 6%, unemployment is completely stable, and labor productivity is doubling its historical average.
It looks great.
I'm looking at this and thinking, we did it. The Fed engineered the perfect soft landing. The inflation dragon is officially slain. But then I turn the page in our stack of sources and I see the commentary from the Federal Reserve officials today. And it is incredibly jarring.
It really is. It's a profound shift in tone compared to what the raw data is currently telling us.
I want to talk about Beth Hammack. She's the president of the Cleveland Fed
Yeah, she spoke today.
in Kettering, Ohio. And according to the sources, she actually dissented at the July Fed meeting, meaning she explicitly voted against holding rates steady.
She wanted another rate hike.
Right. And she used this very specific driving metaphor to explain her reasoning. She said, let me find the quote. I think about it a little bit like when you're driving your car. When you see that stop sign coming, you can either slowly pump your brakes, or if you're not paying attention, you have to jam on the brakes really fast.
Wow.
She firmly believes that the current interest rates are not meaningfully restricting the economy yet.
Which implies she believes the engine is still running way too hot, regardless of what today's PPI print says.
And she wasn't the only one sounding the alarm today. We also heard from Richmond Fed President Tom Barkin.
Right. He gave a speech down in Greenville.
Yeah. And he brought up a statistic that I want us to really dissect. He noted that real, private, non-residential fixed investment grew at a massive 9.5% in the first half of 2026.
Okay, let's translate that term for a second. Real, private, non-residential, fixed investment.
It's a mouthful.
It is. It's just the bureaucratic way of measuring corporate spending on major physical infrastructure.
Like what?
We're talking about building new factories, constructing massive data centers, purchasing heavy manufacturing equipment, upgrading power grids, all of that physical stuff.
And to put that 9.5% growth rate into context, Barkin noted that the pre-pandemic average for that specific metric was only 5.8%.
So corporate infrastructure spending right now is nearly double its historical norm.
And that is the crux of the Federal Reserve's anxiety, isn't it?
Yes. Barkin is characterizing this tsunami of corporate demand as a structural inflationary wind, a wind that the Fed has to fight against regardless of what everyday consumer spending is doing.
Wait, I have to push back on this.
Yeah.
Because it feels completely contradictory.
How so?
You just gave me a detailed breakdown of how the wholesale data proves inflation is cooling off beautifully.
Right.
The costs of raw goods are dropping.
Right.
But Barkin is standing on a stage looking at the horizon saying corporations are spending money on infrastructure like there's no tomorrow. And that is going to cause a massive problem.
Yeah.
So what does this all mean? Are we driving with one foot slammed on the gas and one foot slammed on the brake at the exact same time?
What's fascinating here is that you have to separate the economy into two distinct timelines.
Two timelines.
Yes. The financial markets and the headline data, they are living in the present. They're looking at today's PPI data, celebrating the fact that yesterday's supply chain blockages have cleared up and yesterday's prices have stabilized. But the Federal Reserve isn't tasked with managing yesterday. They are trying to forecast the structural realities of tomorrow.
So they are looking past the current dashboard and staring at the foundational architecture being built underneath the economy.
Exactly. Think about the sheer scale of what a 9.5% growth in infrastructure spending actually entails in the physical world.
It's a lot of building.
Right. If major tech corporations and industrial giants are pouring trillions of dollars into building out new semiconductor fabrication plants in the American Southwest, or constructing hyperscale AI data centers across the Midwest, that doesn't just happen on a spreadsheet.
It requires physical materials, concrete, steel, copper wiring.
Immense amounts of raw materials. And it also requires highly specialized labor. You need thousands of electrical engineers, construction crews, logistics managers.
And crucially, once those facilities are built, they require a staggering amount of constant energy to operate.
Yes. It creates a massive, sustained baseline of demand for resources.
And when demand for those raw materials and specialized laborers skyrockets, the price for those things goes up, regardless of whether a regular consumer decides to buy a new television at Best Buy this weekend.
That is exactly the point Barkin is making. That structural wind of corporate spending is so powerful that it could easily reignite inflation from the bottom up.
It creates a floor on how far prices can actually fall.
Right. And that is why Beth Hammock wants to pump the brakes now by keeping rates high or even raising them. She's terrified that if the Fed cuts rates and lowers the cost of borrowing, it will just throw gasoline on this infrastructure fire, overheating the engine entirely.
Which makes perfect sense when you frame it as an underlying structural demand that is totally insulated from everyday consumer habits.
It does.
But this structural shift isn't happening in a vacuum. Your mention of the staggering energy required to power these new data centers and factories, that collides directly with what is happening globally right now.
Oh, absolutely.
Which leads us to the biggest external threat to this fragile economic equilibrium, the geopolitical wildcard and the bond market.
You simply cannot talk about the threat of persistent inflation in 2026 without looking deeply at the mechanics of the global energy markets.
And our sources today dedicate significant, urgent space to the ongoing situation in the Strait of Hormuz.
Right.
For anyone who hasn't been following this closely, Iran is actively blockading the strait, which is arguably the world's most critical maritime choke point for the global oil trade.
It's massive. A huge percentage of the world's crude oil passes through that very narrow strip of water.
And historically speaking, any disruption in the Strait of Hormuz sends immediate violent shockwaves through the entire global economy.
It's a textbook, unavoidable inflationary trigger because it physically chokes off the supply of the world's most vital commodity.
I understand the historical precedent, but let me stop you right there.
Yeah.
Because I'm looking at the actual commodity pricing data in our sources from today, and it makes absolutely no sense.
It's counterintuitive, isn't it?
It really is. Despite this incredibly tense, active blockade by a foreign military, the price of West Texas Intermediate WTI crude oil actually fell today to $81.88 a barrel.
Yep.
And the global benchmark, Brent crude, fell to around $87.71.
Which is wild to see.
You're telling me a major global oil choke point is actively blockaded and the price of oil went down? That completely defies basic supply and demand. How is the market possibly rationalizing that?
It seems completely irrational if you only look at the geopolitical headline, but commodity markets do not trade on headlines.
What do they trade on?
They trade on physical inventories and forward projections. And the sources point to three distinct complex factors that are currently overpowering the fear of the blockade.
Okay, let's break those down one by one. What is the first factor pushing prices down?
The first is a surprise buildup in domestic U.S. oil inventories. Every week, the Energy Information Administration tracks exactly how much crude oil is sitting in commercial storage tanks across the United States. Analysts have complex models predicting whether those inventories will grow or shrink based on refinery activity and, import-export data.
So we essentially had more oil sitting in physical reserves this week than the market anticipated.
Significantly more. And when domestic inventories build up unexpectedly, it signals to the market that the U.S. economy has an immediate physical cushion.
A buffer.
Right. Even if a foreign supply chain gets disrupted, the domestic refineries have enough crude on hand to keep producing gasoline and diesel in the short term without needing to panic buy on the open market.
And not panic buying drives prices down.
Exactly.
Okay, domestic cushion, that's one. What is the second factor?
The second factor comes from the International Energy Agency, the IEA. They just released a revised, lower forecast for global energy demand.
Why lower?
Well, while the U.S. economy might be humming along, the IEA looks at the macro picture. They see Europe dealing with industrial slowdowns, and they heavily rely on data out of China, which is facing its own severe real estate and manufacturing headwinds.
So if the global manufacturing engine is slowing down outside the U.S., it just requires less fuel.
Exactly. So the market is pricing in a future where we simply won't need as many barrels of oil as we thought we would 6 months ago.
Reduced global appetite, that makes sense. But what about the physical reality of the blockade itself? Surely that has to constrict supply eventually.
And that brings us to the third and perhaps most crucial factor. The U.S. Energy Secretary, Chris Wright, held a press briefing and specifically noted that despite the high-profile naval maneuvers and all the political posturing, nearly 9 million barrels of oil a day still managed to successfully navigate and cross the Strait of Hormuz last week.
Wait, really? So the blockade is more of a massive geopolitical friction point rather than a hermetically sealed wall?
Exactly. The oil is still flowing, albeit with higher insurance premiums and extreme military escort logistics.
But it's moving.
It's moving. So the market looks at the inventory cushion, the reduced global demand, and the fact that tankers are still squeezing through the strait and concludes that the immediate catastrophic physical shortage hasn't manifested yet.
Okay, I see how the oil market is rationalizing the drop in price today. The immediate crisis is averted, and the stock market loves that.
They do.
But the bond market is telling a vastly different, much more ominous story about this exact same situation.
The bond market usually does.
Let's look at the Treasury yields from today. The sources note that the 10-year Treasury yield is currently sitting around 4.65%, while the 2-year Treasury yield is down at 4.12%.
For any institutional investor or really anyone trying to understand the deep mechanics of the economy, the relationship between those two specific yields, the 10-year and the 2-year, is arguably the most important vital sign we have.
I'm looking at the FRI data in our sources, and it highlights something called the T10Y2Y spread, which is just the 10-year yield minus the 2-year yield.
Right.
Currently, that spread is positive by about 53 basis points.
Yeah.
First, for our listeners who don't live in the bond market, what exactly is a basis point? And can you explain in plain English why this specific spread between two government bonds matters so much?
Sure. Let's start with the math. A basis point is just a financial term for 1/100th of 1%. So 53 basis points means the gap between the two yields is 0.53%.
Okay, simple enough.
Now, why does it matter? If we connect this to the bigger picture, you have to understand how a normal yield curve functions. When you buy a U.S. Treasury bond, you are lending money to the government.
Right.
If you lock your money up for 10 years, you're taking on more risk than if you only lock it up for 2 years. A lot can happen in a decade. Inflation can soar, wars can break out.
So you want to be paid more for taking that risk.
Exactly. Therefore, in a healthy, normal economy, investors demand a higher interest rate, a higher yield for the 10-year bond compared to the 2-year bond to compensate for that unknown risk. That creates a curve that slopes upwards over time.
That makes intuitive sense. More time equals more risk, which equals a demand for higher compensation.
Right. But over the past couple of years, we have spent an immense amount of time living with an inverted yield curve.
Right. I've heard that term everywhere.
That is where the 2-year bond actually pays a higher yield than the 10-year bond.
Which sounds completely backwards.
Yeah.
Why would someone accept less money for locking their capital up for a longer period of time?
It happens when the market is absolutely terrified of a near-term economic collapse.
Okay.
If investors believe a severe recession is imminent, they will panic buy the 10-year bond because it is a long-term safe haven. It's a guaranteed return from the U.S. government. And when massive amounts of money flood into buying a bond, the interest rate it pays out gets driven down.
Supply and demand.
Exactly. Simultaneously, the Federal Reserve usually has short-term interest rates hiked very high to fight inflation, which artificially pins the 2-year yield up.
So the short term is forced high, and the long term is driven low by panic.
Right. The result is an inverted curve. And historically, it is the most reliable warning siren that a recession is coming.
But according to the data today, the spread is positive 53 basis points. The 10-year is back to paying more than the 2-year. The curve is uninverting. It is steepening.
It is.
But you mentioned earlier that the bond market is telling an ominous story. If the curve returning to normal is usually a good thing, why is this specific steepening causing anxiety?
Because of how it is steepening. This is what analysts call a structural steepening, and it reveals exactly what the bond market fears.
Walk me through that.
Well, the 2-year yield has been dropping rapidly. Why? Because the bond market is looking at the flat PPI data and the stable jobless claims we discussed, and they are reducing their expectations for near-term rate hikes by the Federal Reserve.
Right. In fact, our sources show the probability of the Fed hiking rates at their upcoming September meeting has plummeted to just 34%.
So the short-term pressure is off. The market thinks the Fed will hold steady or cut soon. However, the 10-year yield is remaining stubbornly elevated. It's anchored right around that 4.65% mark. It is not dropping nearly as fast as the 2-year.
So the gap is widening because the bottom is falling out, not because the top is rising.
Exactly. And this is where the bond market is essentially agreeing with Tom Barkin's speech. The bond market is saying, sure, the Fed might not hike rates next month because the immediate inflation data looks okay. But over the next 10 years, we are deeply worried about a permanent, persistent baseline of inflation.
And that long-term fear is tied directly to things like the Strait of Hormuz and the corporate infrastructure spending we were just talking about.
Exactly. The bond market doesn't just price in what happened this morning. It runs probability distributions for the next decade.
Wow.
If you are an institutional bond trader, you are looking at a world fundamentally reshaping itself. You
Hmm.
see fractured global supply chains that are prone to sudden blockades. You see volatile energy choke points that require military intervention just to keep tankers moving.
And domestically.
Domestically, you see corporations committed to spending trillions of dollars over the next decade, building out data centers and power grids that will consume massive amounts of raw materials.
So the bond market is looking at the geopolitical fragility and the corporate spending boom and saying, this is a recipe for inflation running structurally hotter than it did in the 2010s.
Yes.
And therefore, we demand a high 10-year yield to protect our money from being eaten by that future inflation.
Yes. It is incredible how a blockade halfway across the world in the Middle East and a boardroom decision to build a data center in Ohio, they both manifest in the exact same mathematical bond market metric.
It really is. It's all connected. And speaking of those boardroom decisions, Barkin mentioned that corporate investment grew at 9.5%. Where exactly is all of that capital flowing? Because it isn't just going into generic office buildings.
Oh, definitely not. A historic, almost unprecedented percentage of that capital is flowing straight into the physical and digital infrastructure required for artificial intelligence.
Which leads us perfectly into the most fascinating dynamic in the equity markets right now, the great AI bifurcation.
Yes, this is huge.
Because if you look at the stock market action today, it wasn't just a broad generic rally where a rising tide lifted all boats. It was an incredibly specific, almost surgical repricing of the entire technology sector.
It was a highly revealing day. We are watching investors rapidly mature in their understanding of the AI ecosystem in real time.
The AGF Perspectives article in our stack lays this evolution out brilliantly. For the last couple of years, artificial intelligence has obviously been the dominant narrative on Wall Street.
Right.
But the focus was almost entirely on one specific thing: who had the best large language model, or LLM. It was an arms race between OpenAI, Google, Anthropic to see whose chatbot could write the best code or pass the bar exam.
That was phase one.
Right. But AGF is now arguing that chasing LLM leadership is rapidly becoming a futile exercise for investors. Why would the core intelligence of these systems suddenly become futile?
Because the core technology is commoditizing infinitely faster than anyone on Wall Street predicted.
Really?
Yeah. The AGF piece highlights a stunning reality. The performance gap between the absolute top-tier U.S. models and the leading Chinese models has narrowed to the point of being negligible.
I see your point, but how is that physically possible?
Well,
I mean, we know for a fact that the U.S. government has enacted incredibly strict export controls. They're actively preventing China from accessing the most advanced, highest-end NVIDIA GPUs, which are the engines required to train these massive models. If they don't have the hardware, how are they matching the software?
it comes down to algorithmic efficiency versus brute force compute.
Okay, explain that.
The U.S. companies initially gained dominance by throwing massive, incredibly expensive clusters of the best hardware at the problem. They just brute forced it. But Chinese developers facing severe hardware constraints were forced to innovate on the software side.
Because they had no other choice.
Exactly. They focus heavily on algorithmic efficiency, optimizing how data is processed, and utilizing advanced techniques to squeeze maximum performance out of older or less powerful chips.
So necessity truly was the mother of invention. They couldn't buy the biggest engine, so they built a more aerodynamic car.
That's a great analogy. And the result is that having the most expensive proprietary model in the world is no longer a durable economic moat. The leaderboards for which model is objectively best at coding or reasoning rotate every few weeks now.
It's constantly shifting.
Right. If you are a massive enterprise customer, say a global bank or a logistics giant, you are looking at this landscape and realizing you don't necessarily need to lock yourself into a massive multi-million-dollar contract for a premium proprietary model.
Because open source models, or just cheaper alternatives, can handle 95% of your high-intensity workflows just as effectively.
Right. And when the core product becomes easily substitutable, the price drops, margins collapse, and it becomes a commodity. That is why AGF says the era of the LLM premium is ending.
Okay, so if the brain itself, the LLM, isn't the golden goose anymore, what is the market looking for? Where is the real money to be made?
According to the analysis today, the new frontier is entirely focused on execution and application.
execution.
Specifically, the market is pivoting toward physical AI, which involves robotics, autonomous vehicles, automated manufacturing, and a concept called agentic AI, which focuses on total workflow automation.
Let's break down agentic AI because that term is popping up everywhere in our sources.
Uh-huh.
How is an agent different from the chatbots everyone is currently using?
We are moving past the conversational phase of AI. Right now, you interact with an LLM by asking it a question and it gives you text back.
Right, like a super smart search engine.
Yeah, but you are still doing the work of prompting it, analyzing the answer, and applying it. Agentic AI refers to autonomous digital teammates. Instead of asking a question, you give an agent a high-level goal. For example, audit these 500 vendor invoices, cross-reference them with our inventory database, flag any discrepancies, and draft an email to the accounting department outlining the errors.
So it's not just answering a query, it is independently executing a multi-step workflow across different software platforms without any human intervention in the middle.
Exactly. And building a system capable of executing that flawlessly requires incredible ecosystem strength, deep integration into corporate software networks, and complex security protocols. It requires much more than just raw conversational intelligence.
So the moat is in the execution, not the brain.
Right. The companies that can build those secure, reliable execution layers are the ones who will capture the real value in the next phase of the AI boom.
And while the theory of agentic AI is fascinating to discuss, the actual capital flowing into it is staggering.
It's mind-blowing.
Look at the massive news out of Anthropic today. Our sources detail that they are currently in advanced talks to acquire an AI startup called Descartes for $6 billion. But even more massively, Anthropic is actively targeting an October initial public offering, an IPO, with a proposed valuation of over $2 trillion.
$2 trillion for a company that was founded less than 5 years ago.
It is an astronomical number. I have to push back on the sheer scale of that. How does any investment bank on Wall Street mathematically justify assigning a $2 trillion valuation to a startup, even an incredibly successful one?
It requires pricing in a complete paradigm shift in the global economy. To justify that number, underwriters are leaning on massive, aggressive forward projections. The sources indicate that this valuation is heavily based on projections that Anthropic will hit $100 billion to $120 billion in annual revenue by the end of 2026.
Over $100 billion in revenue in a few years. For context, it took Microsoft and Apple decades of global hardware and software dominance to reach those types of revenue run rates.
Which highlights the sheer scale of capital required and expected in this space. The market is betting that the transition to agentic AI won't just be a new software tool, but will essentially replace vast swaths of human operational labor across the Fortune 500, capturing trillions in efficiency gains.
But, and this is where the great AI bifurcation actually happens in the market, investors are no longer blindly throwing money at every company that claims to be involved in this revolution. We have reached a critical maturity point.
We really have.
Let's look at the specific winners and losers from today's trading session to illustrate this. On the winning side, we have SanDisk. Their stock skyrocketed 13.6% today.
A huge day for them.
The catalyst. They unveiled their new BuyCS9 and BuyCS10 QLC flash memory technology. But more importantly than the tech itself, they explicitly targeted an 80% gross margin by the year 2028.
That 80% margin target is the entire reason the stock exploded.
Break that down for me. Why is QLC flash memory so critical right now, and how on earth does a hardware manufacturer command an 80% gross margin?
Flash memory is the storage component of the data center. While GPUs like NVIDIA's process the math for AI, you need massive, incredibly fast storage systems to hold the petabytes of data the AI is learning from.
Okay.
QLC stands for quad-level cell. Without getting too deep into the engineering, it is a technology that allows you to pack significantly more data into the exact same physical footprint on a silicon chip.
It compresses it.
It dramatically increases data density while lowering the physical space and energy required to run it.
So it solves the physical constraints of building these massive data centers we talked about earlier.
Yes. And because the demand for high-density, low-power storage is so insatiable right now, and the engineering required to build BuyCS9 and BuyCS10 is so brutally complex, SanDisk essentially has a temporary monopoly on this specific performance tier.
They have a chokehold on it.
They have extreme pricing power. When you possess a technology that is absolute critical infrastructure for your customer's multi-billion-dollar data center, and they cannot substitute it with a cheaper alternative, you can dictate the price. That is how you project 80% gross margins.
It's a completely captive market. Now, contrast that pricing power with the massive losers we saw today. Cisco is down over 8% due to a projected significant slowdown in their AI data center networking sales.
Yeah, that was rough.
And even more shockingly, Cerebra Systems, which was one of the darlings of the AI hardware space, plummeted 16% today. The sources note that while their cloud business actually quadrupled in growth, their core hardware revenues and their gross margins completely missed Wall Street expectations.
Which is the brutal reality of the bifurcation playing out in real time.
I think we need a better metaphor than the cliché selling pickaxes during a gold rush. It feels like we have transitioned from a phase where venture capitalists would fund anyone who could sketch a blueprint of a rocket ship on a napkin. Now, we are in a phase where investors are standing on the launch pad, arms crossed, demanding to see the actual payload capacity, the structural integrity reports, and the precise cost of the fuel before they hand over a single dime.
That is a much more accurate framework. The AGF article hits on this exact dynamic. The narrative has shifted. AI is no longer just a theoretical technology play. It is entirely about commercialization and profitability.
Right.
The market is aggressively punishing companies experiencing margin degradation, like Cerebra's, or slower revenue conversion, like Cisco.
They're demanding concrete proof of profitability, not just proof of concept.
Exactly. Gross margins are the ultimate truth teller in financial statements. They tell you unequivocally if a company actually has a competitive moat.
Right.
If your margins are shrinking in the middle of the biggest tech boom in a generation, it means your product is becoming a commodity. It means your customers have found cheaper alternatives and you are being forced to lower your prices just to maintain market share.
And in a market moving this rapidly, commoditization is a death sentence for your stock price.
It really is. The bifurcation we saw today is the market ruthlessly separating the indispensable infrastructure providers who can defend their margins from the easily replaceable vendors who are racing to the bottom.
It is an absolutely ruthless proving ground. And that dynamic transitions us perfectly into looking at the specific corporate balance sheets that were released today.
We're getting into the weeds now.
We're moving from the broad macro trends of AI and inflation down into the granular reality of how specific companies are actually operating in this environment. Let's start with a massive bellwether for the entire semiconductor industry. Applied Materials, ticker AMAT.
Right. They report after the bell today.
Yeah, scheduled for Q3 earnings. Expectations are highly tuned, set at $3.39 for earnings per share, and just under $9 billion in total revenue. Now, this stock has been on a wild, volatile ride.
Oh, for sure.
It is up 108% year-to-date, reflecting the massive AI boom, but it has actually pulled back a severe 24% from its recent all-time highs.
Which perfectly illustrates the acute anxiety around valuation and execution we just discussed with the bifurcation. I mean, 108% gain is phenomenal.
Unbelievable.
But when a stock suffers a rapid 24% pullback, it shows how quickly institutional investors will pull their capital and take profits if they sense even a hint of fundamental headwinds.
And there are very real headwinds here, despite their massive technological partnerships, like the state-of-the-art EPIC research facility they are building with UC Berkeley.
Yeah, that's a big project.
But the sources point out a specific massive roadblock. Applied Materials is facing a projected $600 million to $710 million drag on their revenue due to the China BIS affiliates rule.
Yeah, the BIS rule.
Break down this rule for us because it sounds like a massive geopolitical anchor tied around a tech company.
The Bureau of Industry and Security, or BIS, rules are the perfect real-world example of how global geopolitics directly throttles the technology sector. The U.S. government, citing severe national security concerns, has aggressively restricted the export of advanced semiconductor manufacturing equipment to China. Okay. They do not want China acquiring the machines necessary to build the chips that power advanced military AI or hypersonic weapons.
And Applied Materials makes the exact machines that the government is restricting.
Precisely. They build the incredibly complex fabrication tools that companies like TSMC and Intel use to actually print the microchips.
The actual hardware.
Yes. So the BIS affiliates rule dictates that no matter how much legitimate commercial demand there is in China for these tools, and no matter how much Chinese companies are willing to pay, Applied Materials is legally, structurally locked out of selling their high-end portfolio to a massive chunk of the global market.
It is a policy-driven revenue ceiling. It has nothing to do with the quality of their product. It is entirely dictated by Washington.
Yes. And it is a ceiling that investors have to meticulously price into the stock. The entire thesis for Applied Materials earnings today hinges on a very specific question.
What's the question?
Will the explosive, unprecedented demand from U.S. and European data centers be large enough to completely offset and outpace the $700 million geopolitical drag caused by losing the Chinese market?
Wow.
That is the specific metric the market is waiting to see in their forward guidance.
It is a high-stakes balancing act. But let's step completely out of the high-tech, multi-billion-dollar AI bubble for a minute.
Yeah.
Because the broader U.S. economy is vastly wider and far more mundane than just semiconductor fabrication.
Oh, yes.
Let's look at a company that reported today called Alliance Laundry, ticker ALH. They manufacture commercial washing machines and dryers.
Commercial laundry is quite literally as far removed from agentic AI and quantum computing as you can get in the public market.
Exactly. And yet, their earnings report is one of the most fascinating reads in our stack today. They reported Q2 revenue growth of 7%, hitting $477 million.
Solid numbers.
But more importantly, in an environment where we just discussed companies struggling with inflation and margin compression, Alliance Laundry expanded their adjusted EBITDA by 12%, and their gross margins reached a massive 39.8%.
That's incredible.
For a heavy manufacturing company building steel boxes, how are they expanding margins so aggressively during a period of complex global inflation and supply chain disruption?
Well, before we answer how, let's briefly define EBITDA for clarity.
Right.
It stands for earnings before interest, taxes, depreciation, and amortization. It is essentially a metric that shows the pure operational profitability of a company's core business, stripping out the accounting nuances of debt and taxes.
Okay, so it's the core engine.
Right. Expanding EBITDA by 12% on only 7% revenue growth means they are becoming hyper-efficient at converting sales into actual cash.
So they are getting significantly better at keeping the money they make. How are they executing that?
The sources highlight a very specific operational strategy they deploy called local-for-local manufacturing.
Local for local.
Yeah. Alliance Laundry has strategically built and scaled major manufacturing facilities in North America, the Czech Republic, and Thailand.
The name implies they build the machines in the exact same region where they intend to sell them.
Exactly. And the mechanics of that strategy are brilliant when you look at the macro threats we discussed earlier.
Like the shipping issues.
Yes. Think about what we covered regarding the Strait of Hormuz and volatile energy costs. If you manufacture a 500-pound commercial washing machine in Asia and your primary customer is a hotel chain in Chicago, you have to pay massive oceanic shipping costs.
Right.
You have to burn expensive diesel fuel to move it across the Pacific. You are subject to the volatile whims of global maritime choke points, and you face intense U.S. import tariffs.
Every single step in that journey eats away at your gross margin.
Exactly. By localizing production building the machines destined for Europe in the Czech Republic and the machines destined for the U.S. in North America, Alliance Laundry drastically reduces their exposure to those global friction points.
It's just smarter logistics.
Way smarter. They aren't paying trans-Pacific shipping rates. They are sourcing local steel, which hedges against localized supply chain shocks. They bypass international tariffs entirely.
It is an incredible operational hedge against the exact type of macroeconomic volatility that is keeping the Federal Reserve awake at night.
It truly is. While the massive tech companies are fighting existential battles over AI commoditization and geopolitical export bans, Alliance Laundry is quietly utilizing boring geographic diversification to maintain absolute pricing discipline and grow their margins.
In a totally non-discretionary market.
Exactly. Because at the end of the day, regardless of whether inflation is 2% or 5%, hospitals, hotels, and consumers still need clean clothes.
It is a great reminder that strong, disciplined operational execution wins in any sector, no matter how unglamorous. Now, speaking of what people actually need versus what they discretionary choose to buy, let's look at the consumer health split we saw in the retail earnings today. We often talk about the consumer as if it is one giant collective organism, but today's earnings paint an incredibly fractured picture.
The consumer is never a monolith. The impact of inflation and interest rates is highly asymmetrical depending on in-game brackets.
We saw that asymmetry play out perfectly today. Let's look at Tapestry, the luxury parent company that owns brands like Coach and Kate Spade.
Yeah, tough day for them.
Their stock fell 7% today based on highly disappointing forward guidance. Management specifically cited severe weakness and lower foot traffic at their Kate Spade stores.
This is a classic textbook example of the mid-tier luxury squeeze.
Squeeze.
When inflation elevates the baseline cost of living, groceries, rent, insurance, the aspirational middle-class consumer is the first to cut back on discretionary spending. They are the ones who decide they don't need a new $400 handbag this season.
But on the exact same day, in the exact same retail environment, Birkenstock, the footwear company, jumped 10%.
Right.
The analysts in our sources specifically cite their high-end retail resilience and incredibly strong direct-to-consumer demand. So the consumer won't buy the $400 handbag, but they are absolutely willing to pay $200 for a premium sandal.
It highlights a shift in utility. The consumer is still spending, but they are ruthlessly prioritizing brands that offer perceived durability and high daily utility over pure status symbols.
And then you look at the so-called experience economy, and we see massive operational failures punishing stocks.
Oh, StubHub.
Yeah, StubHub. The massive secondary ticketing platform saw their stock tank 19% today. Why? Not because people stopped going to events, but because of a disastrous internal operational fiasco.
There's a mess.
They had a massive partnership failure regarding World Cup tickets that essentially wiped out their entire quarterly profit, leaving thousands of furious customers stranded outside stadiums with invalid QR codes.
If we connect all these individual earnings stories to the bigger macroeconomic picture, this slate perfectly encapsulates the staggering complexity of the 2026 economy.
It really does.
We have hyperscale, trillion-dollar AI growth attempting to automate the white-collar workforce, happening at the exact same time that consumers are agonizing over whether to buy sandals or handbags. All while a ticketing giant blows up its own profit margins through sheer operational incompetence.
And just to throw one final massive wild card into the mix of how fractured this market is, Workday ticker WDAY, the massive enterprise software company, skyrocketed 25% today.
A crazy move.
The volatility was so violent that the exchange actually halted trading on the stock. The catalyst was rampant, credible rumors of a $43 billion buyout by the private equity firm Silver Lake.
It just proves that you cannot simply buy a broad index fund right now. Close your eyes and expect uniform, steady growth across the board. The divergence between the winners and the losers, whether you are looking at AI hardware manufacturers, mid-tier consumer retail, or massive software M&A targets, is widening aggressively.
It's all over the place.
Navigating this market requires incredibly careful stock selection, a deep understanding of gross margin sustainability, and a clear view of how underlying business models hold up against geopolitical stress.
It is a stock picker's market without a doubt. The era of the easy rising tide is over.
Definitely over.
Okay, we have covered a massive amount of highly complex ground today. Let's do a quick synthesis of where we stand.
It has been an incredibly dense dive into the mechanics of the economy today.
The headline takeaway from the data is that inflation, measured by the PPI, looks incredibly friendly, giving the stock market the immediate justification it needed to push the S&P 500 to new record highs.
Right.
However, beneath that celebratory surface, the Federal Reserve is keeping its hand hovering firmly over the emergency brake, deeply concerned that the trillions of dollars being poured into corporate AI infrastructure will reignite structural inflation. Meanwhile, that very same AI boom is rapidly maturing from a phase of blind hype into a brutal, margin-obsessed proving ground, where physical execution and pricing power mean everything.
Execution is everything now.
And through it all, the broader consumer economy remains highly fractured, rewarding companies that execute flawlessly and ruthlessly, punishing any operational missteps or loss of pricing power.
It is an environment that demands intense vigilance from investors. The easy money phase of the macroeconomic cycle is clearly in the rearview mirror.
It really is. And before we go, I want to leave you, the listener, with a final provocative thought to chew on.
I like these.
Throughout this deep dive, we spent a lot of time analyzing the theory of AI automation, and we spent time analyzing the granular shifts in consumer behavior. Well, buried deep in our sources today was a fascinating, almost dystopian juxtaposition of those two themes.
This is wild.
On one hand, it was revealed that McDonald's has built a massive 515-page digital dossier on its loyalty customers. They are utilizing vast amounts of data processing just to track the hyper-granular spending habits of people buying cheeseburgers.
515 pages of analytics to predict a fast food purchase. The scale of data harvesting is staggering.
Right. And simultaneously, we read the report that Anthropic is actively testing those new autonomous agentic AI models we discussed earlier.
The agents.
And during a test, when they set multiple AI agents loose in an enclosed environment and gave them the exact same task, the autonomous agents actually started a digital turf war with each other.
They were fighting.
They were competing aggressively and blocking each other's workflows to achieve the goal first.
Which is both a fascinating leap in autonomous behavior and deeply terrifying from a system stability standpoint.
So here's the question I want to leave you with. As we rapidly deploy these hyper-intelligent, highly autonomous AI agents into an economy where megacorporations already hold 500-page dossiers predicting our every personal behavior and financial habit, are the biggest future risks to our financial markets going to come from traditional macro metrics like inflation, the yield curve, and interest rates? Or are they going to come from the unpredictable, autonomous turf wars of the digital systems we are actively building to run our lives, operating at a speed and complexity that humans can no longer control?
This raises an incredibly important question about systemic algorithmic risk that goes far, far beyond forecasting a 10-year Treasury yield.
It makes you wonder who or what is actually going to be driving the car a few years from now. Keep questioning the narrative, look beyond the headline numbers, and thank you for taking this deep dive into the sources with us today.